So today we are doing week 7, right?
Yes, week 6 and 7 both because last week
Oh,
we did revisions.
week 5 we did before quiz 1.
Yes. Okay. So hi Samit, hi everyone. So welcome to our live session for the corporate finance course. Today we will be discussing the content of week 6 and 7. I think we will not be completely covering week 7, but we will complete it with week 8 discussion. So in week 6, we primarily discussed about how individuals make preferences, and we started our discussion with when the environment, the economic environment is certain, like everything is known with certainty. So, for example, there is an individual, let's suppose Samit is an individual and his income is 100 units, and he wants to invest in two types of goods, X1 and X2. These two goods can be anything, let's suppose X1 is coconut and X2 is rice, and he wants to decide how much of income he would like to give to coconut and how much to rice. Okay, so first of all, he has a threshold, like he has only 100 units, so he can, at max, he can only like spend 100 units on these two goods. So from that, we can derive an inequality which we call the budget set. That is budget set that is denoted by this inequality which we call the budget set, and we can represent this budget set in x1 x2 plane, and that budget set is represented by this, like the grid area which is represented by this green grid area. Okay, and the boundary, the topmost boundary, is represented by a line. That is, like when we replace this inequality by an equality, then it becomes a line in x1 x2 goods plane, and we call that budget line. This is the expression for the budget line, and this blue line is the budget line. So in choice theory, there are three components. First, our budget set comes into the picture. Then preferences, like what are the, for example, we are taking the example of Samit. So if Samit has this income and he wants to consume these two types of goods, then this is his budget set. Like these are the available bundles to Samit. Now, which one is the most preferred one for Samit? That is decided according to his preferences. And we represent an individual's preferences by utility function. And what is a utility function? We simply, this is a representation of preferences, and how, like we are just giving a functional form for the preferences. So for example, if Samit prefers this x1 x2 bundle over this x1 prime x2 prime bundle, then a utility function should be such that, like the if we apply that function to the first bundle, that should be greater than if we apply that function to the second bundle. Okay, and from utility function we can derive indifference curves. What are those? Like those are the collection of the bundles. Bundles means this combination of good one and good two, which are equally preferred, like which gives that individual same amount of preferences. Okay, and the form of indifference curves. Why we use indifference curves? Because we can represent them in x1 x2 plane. That's why. And when we represent it in normal preferences, those are represented by, like those are downward sloping, and the farther we move away from the origin, the higher is our utility. Okay, and slope of this indifference curves is marginal rate of substitution, and that is like we derived it in the lectures also. This is like the negative of the ratio of the marginal utilities. And let's take an example. For example, if some utility is represented by this square root function, so square root x1 plus square root x2, then how can you derive x1 x2, like the marginal rate of substitution at x1 and x2. So for that, like you need to partially de- derive the partial derivative of this utility functions and take the ratio, and from that you can get like the what is the marginal rate of substitution of x1 and x2. Okay, so what is the meaning of this marginal rate of substitution? So for example, let's take any point. For example, if we take a point x1 equal to 25 and x2 equal to 9, if we take that, then what would be our marginal rate of substitution? That would be, I think, 3 by 5, correct? I am not wrong. Minus 3 by 5. So what does this minus 3 by 5 means? That means like at this point 25 comma 9, at this point in this x1 x2 plane, if consumption of good one, that is x1, that changes by some small unit delta, then in order to keep my utility same, an individual should change his consumption of x2 by minus 3 by 5 delta 1 units. Okay, to keep the utility at the same level. That is the meaning of this marginal rate of substitution. So if you are changing your consumption of some good, then how much amount you are required to change consumption of other goods in order to keep your utility at the same level. That is the meaning of marginal rate of substitution. So we have covered budget set, we have covered preferences. Now we combine both of them, and then we we get to the individual's choice. So what would be our problem? Our problem would be like to maximize the utility of the individual, that is represented by this utility function subject to my budget constraint. That is my budget set. So these are my available bundles, and I want the bundles which maximizes my utility. We can use the Lagrangian method there. Okay, and from that what solution we get? The solution which we get is the marginal rate of substitution, that is equal to the negative of the ratio of prices. That is like this will be my optimal point. Okay, let's have a look at it graphically, and then we will discuss this numerical example. So this was my budget set. Okay, this triangular shape, these were my indifference curves. So in this side, like these are more away from the origin, more preferred they are. Okay, and so if we combine both of them, this is my fixed, so I want the one which is farthest away from the origin, so that would be the one in difference curve that is tangent to this my budget line. Correct, and that is essentially my this solution to this like the choice problem. So this is
So
also like
why
MRS equal to, hello.
yeah, why this further away from the origin is always preferred?
Because this is how the utility function is defined. If both of them are goods, like if you want more of both the goods, for example, if you want more of rice and more of coconut, then the type of utility function which you get, and from that the type of indifference curve you get, that would give you this shape of indifference curve. And in that shape, like the farthest away you are, like the more away you would be from the origin, more of good one and good two you will have. And that is the, like, if you are a rational person, you would want that, correct? Because
But
we are saying,
further
like,
away, further away of the indifference curve mean that time I also need to shift my budget line to further away, right?
no, no,
To
no,
we
your
get
budget
the
line is fixed. Your budget line is
action.
not moving. Your budget is fixed. Like your budget is like this one, whatever P1 X1 plus P2 X2. Your budget line would be equal to M. M is your income. Your income is fixed. These prices you know, and in X1 X2 plan this will be a like straight line that is fixed. So you have this fixed line. You want an indifference curve that is like the farthest away from the origin, and that comes out to be this tangent, the indifference curve, which is tangent to this budget line. Okay, and that is essentially my solution also. Like the slope of indifference curve is the marginal rate of substitution that is equal to slope of the budget line.
Okay.
Okay, so in our continuing our example, so our utility was given by this square root of x1 plus the square root of x2, and this was my budget set, and I can set up Lagrangian this one, and we can derive the solution, which gives me like MRS is minus x2, we derived it earlier, minus of x2 by square root of x2 by square root of x1. So I have removed the negative signs, and this gives me like, and I have derived the solution. So these are my solutions. So this is my preferred combination of consumption. So which gives me which is like the feasible to me, as well as it gives me the highest highest utility from the available bundles. Okay. So this was the case when like the prices, income, utility, etc. were known to you. Okay. Now comes the situation like when there is uncertainty in the economic environment. So you do not know with certain that what is going to happen in future. So for example, there may be a good situation where there may be a bad situation, and according to the situation which is going to persist, your income would change, for example, or your payout may change, your prices may change. So so in that case, like we derive state contingent budget constraint because our payouts so our payouts or incomes are like the state dependent. That's why we call it sorry, state contingent budget constraint. So for example, let's suppose there are two states. First is, so there is a 20% chance that they in future there would be a bad state. There is 80% chance there will be a good state. So it can be anything. So anything like in bad state you can have an accident, in good state you don't have an accident. It can be anything. Okay. So let's denote the payout, like the payout or the consumption by, like in bad state by CB and in the good state by CG. So if bad state occurs, then your consumption is 25. If good state occurs, then your consumption is 100. Okay. And there is a insurance policy available to you, which gives you a insurance cover of X rupees or X units with a premium of 0.2, like 20% of the coverage you have to pay in the form of insurance premium. So if this is the situation, then we can derive a state contingent budget constraint we can derive our expected utility function, and from that we can do the same analysis and we can come up to like the our optimal consumption point. So how do we do that? So what is the meaning of insurance? Insurance means like if you take this insurance, this means like if in future the state remains good, then like they would the insurance company or insurance provider will not give you any payout because situation remains good. In that case you only pay your premium. But if situation turns out to be bad, then insurance provider will pay you X amount of coverage and you will be paying the premium and you will receive like you will be having your consumption in the bad state. Okay. So we have these two equations. In these two equations, what do we do? Like we have this coverage amount X which we do not know. So what we do, like if we can eliminate this X, then it would give me an equation in the form of CB and CG, and we will call that the state contingent budget constraint. Okay, so how do we do that? So the first equation is CB equal to 25 plus, correct, and second equation is correct. So if I multiply the first equation with 0.2, I am multiplying it with 0.2 and this with 0.8, and then I am summing both these equations, then that would give me okay, and these two terms will be eliminated because these two terms remain equals, and this is like I get an equation in the parameters CB and CG, and we call it state contingent budget constraint. Okay, and now as we know, like the future is not known to you, then instead of using the utility function, we use expected utility function. So what is the expected utility function? This like this E notation would come in front of utility function and we call that expected utility function. So the so there is like the 20% chance that you will have bad consumption and there is 80% chance that you will have good consumption. So this will be my expected utility function. If my utility function is given by this form, I can derive the marginal rate of substitution. I have the ratio of this, like the slope of this project constraint that turns out to be minus 1 by 4 if I take CB in the horizontal axis and CG in the vertical axis, and I can do the same analysis and I can get to the point like get to my optimal point in which like the this is my optimality condition, like I should have same consumption in good and bad state, and accordingly I can like the and that should be equal to 85. What does that mean? That you were having CB equal to 25 and CG equal to 100, correct? So it is saying you should have like the same amount of consumption in both the periods. So how much coverage you need to purchase? I think that would be 60. And for that, how much you will be paying? Am I doing something wrong? Hello? I think I made some mistake. 585 is correct. Okay, this should be 85. If this should be 85, then my coverage should be okay, okay. Not this one, my coverage should be. So how much coverage should I buy? 100 minus 0.2x, correct? So that means x equal to 15 by 0.2. That is means 75 units of insurance you should purchase, so that that is the optimal point for you if you have this condition. So if you buy 75 units of insurance, then that would give you equal consumption in both the states, and that is optimal for you in this case. Okay, is this clear? If you have any doubts, please stop me right there and please clear out your doubts accordingly.
It's okay, sir.
Okay. So in the meanwhile, we also had a discussion about the certainty equivalent. What do we mean by certainty equivalent? That is, like, certainty equivalent is like the amount of money which is given to an individual with certainty, so that he is equally well off with a given lottery. Lottery means, like, for example, a good and bad state. This is an example of lottery. Like, you are not fully certain about the future. Okay. So if this is the case, then how much amount you should have, so that you are equally satisfied, or equally, like, your utility is same. So how do we do that? So for given in the above example, so what was your expected utility in the above example? That means, like, your expected utility in the above example, in 20% chances you were having bad state, in 80% chances you were having good state, and if we combine it, your expected utility was 9. So how much amount you should be given with certainty, so that your expected utility is same in both the cases? So that would be like, your utility function was given by this form, where x is your consumption amount. So let's note it by c only. Okay. So if this was your utility function, then certainty equivalent means how much consumption you should have with certainty, so that your utility is same as this load value. So that would be like, we can get this amount by equating my utility with the certainty equivalent. They should be equal to 9, and from that I get 81 as certainty equivalent. What does that mean? So if I get 81 with certainty, and otherwise if I go for this lottery or this uncertain situation, my expected utility would be same. That is the meaning of certainty equivalent. Now, these were
Clear
the
enough.
cases. These were the cases where we were discussing about, like, the normal goods. But in this course, we are discussing about investments and our choices about different types of assets. Correct. So for investment, like, in generally we listen a lot, like, high risk, high return. But if you are an individual, or if you are an investor, then you would always prefer higher amount of return and less amount of risk. Correct. And through return, what we mean, like, you should have high mean, like high mean rate of return, average rate of return, it should be high. And the variation, like, as you know, like, if I invest something, there would be, like, the variation in my return is should be lesser. That is the most preferred. Like, variation is a type of measure of a risk involved in a particular type of investment. Okay. So here the thing is different as compared to our previous discussion of two good case, two goods. Goods means you prefer both the things. Like, the goods we took coconut and rice. Like, an individual like Samit, he would prefer both of them. But here the things have changed. You prefer the mean, but you like less of variation. So in that case, your utility utility function or the indifference curves would be such that, like earlier the utility functions were of this form, like downward sloping, but in this case your utility functions will be this upward sloping. Why? Because you would prefer less of this sigma and variation, and more of return. Here you are you are preferring more of good one and more of good two. That's why the shape of indifference curve was like that. But in this case, your shape of indifference curve would be like this upward sloping shapes you would have. And the more preferred will be like in this direction, this blue arrow direction would be your preferred indifference curve direction. So more in this direction, that means you are having more utility. And this variation is represented by standard deviation. And I think you all remember the statistical jargons of mean and standard deviation, variance, covariance, and correlations. If you do not like I think that in the slides it has been discussed extensively regarding the statistic formula for these statistics. Now we got the preferences in the case of risky assets. Now, how to derive the budget constraint? Budget constraint. So now we have defined these preferences in mean and standard deviation plane. So now I would require my budget constraint in this plane also. So this should be like a function of mu. I am representing mean with mu and sigma. Sigma means this standard deviation or the variation. So let, for example, if I am deciding about investing in two types of asset. One is risky, another is risk free. Risk free means like you will be having certain you will be having certain return. That we represent that by RF. RF means risk free return. Okay. Now there is another asset which is risky, which has mean return of RM and standard deviation of sigma m. And as you know, like high risk, high return, that means like this RMs would be greater than RF. Now, for example, you have some wealth W. You want to build a portfolio with investing X portion of your wealth in risky asset and 1 minus X portion of your wealth in risk free asset. Okay, then what would be your portfolio return? That means like this Rx is your portfolio return. That would be X times, like this is the mean portfolio return. That would be X times RM. That is the return on risky asset. 1 minus X times RF. Okay. Now, what would be your standard, like the variance of your portfolio? That would be like there is no variance coming from risk-free asset. So only variance that is coming from this risky asset. And we all know, like if A has variance of sigma A square, then XA would have variance of X square sigma A square, correct? From statistics class, we know that. So from that, we know that the variance of the portfolio, this is the portfolio variance, that would be X square sigma square M. And I can rewrite this in the form of sigma X is equal to X times sigma M. Okay. Now I can combine both of them and I can get an equation in, as I told you, like I need an equation in R. sigma rx, sigma x. So for that, what I need to do? So I need to remove this unknown parameter, that is x. Okay. So how do we do that? So I can replace this x in above equation by x equal to sigma x by sigma m. If I replace this in the above equation, so that becomes this and this, and I can combine both of them. Then Rx equal to Rf, which is known to me, and Rm is known to me, sigma Rf is known to me, and sigma m is known to me, and this is sigma x. So I got an equation which has a positive slope. How do I know that? Because as I discussed earlier, Rm is greater than Rf. That means this slope is positive. So this is a positive sloping line with a positive slope. Okay. Now how do we derive that? So this is sigma this. So if sigma is 0, then what is Rx? That is Rx equal to Rf. Correct? So this one point will be this. And second point is when sigma x is equal to sigma m. If that is the case, then Rm minus Rf, then Rx becomes Rf. So this is the second point. So the first point is risk-free asset. So, and this is the risky asset. And we got this straight line, and this is the budget constraint of this, like the assets case. If you are investing in the risky and risk-free assets, then this is your budget constraint. Now we do the same analysis, like we have preferences which were represented by these upward sloping indifference curves, and we have this upward sloping budget constraint. The optimal point would be one where the indifference curve just tangent to the budget constraint. Okay, so this will be my optimal portfolio, or the optimal like investment bundle in the like the which is represented in the form of mu and sigma, where mu is my mean portfolio return, and this is my portfolio standard deviation. Okay, is there any doubts? Any? Okay. So now, now there was a discussion like how do we choose between risky assets? Okay, so we choose risky assets by comparing this this parameter, like the Rm minus. So let's suppose there are two assets, X and Y, and X has Rx and sigma X, like the mean return of this asset and standard deviation of this asset, and Ry and sigma Y. Then we compare this formula, and this formula is known as the Sharpe ratio, which will be coming in week 8 discussion if it has not come yet. And we compare the Sharpe ratio of these two assets, and the asset which has higher Sharpe ratio, we, like a rational individual, would choose that asset. Okay. Now, as we discussed earlier, like a rational individual would prefer higher average return, higher mean return, and less of risk. Now, this risk can be measured in many forms, and the most simplest one is the standard deviation. We take standard deviation as a measure of risk, because it is giving the variation in that particular asset return. But in in real life, there are various measures of risk. So, for example, there is value at risk, there is expected shortfall, etc., etc. We are not going into that, but the one simple one is the beta of a particular asset. And what is a beta? Beta is nothing but like the risk that is coming from asset and risk of the whole market. The ratio of both of them, we call that beta. So beta is nothing, just the like the risk of the whole market and how much of that is coming from asset I. That is this beta. And this we take as a form of risk. So the total riskiness of this asset would be like the beta I times the market risk. That would be the total riskiness of this asset. And the risk of asset I, we denote that by covariance of RIRM, and whole market is variance of RM. And this will be covered, I think, in week 11 or 12, I think, where we will discuss this capital asset pricing model extensively. So capital asset pricing model gives us a benchmark of a like benchmark about the returns of a particular asset. Like how much, if these are the conditions, then how much would be the expected return of a particular asset. That gives me a benchmark, and if that asset gives me high return, then I would prefer to invest in that. And if that investment gives me less than that, then I should not go for that if I am a rational investor. Okay. Now the the one thing like which I wanted to highlight, like as I said, like the how do we decide between these two? So this is, if you take a look at it, like this is the slope of my budget line. Okay. So let's take an example. So for example, if this was sigma, this was mu. If this was my first line and this is my second line, so this is, so x is higher now. So this is for x and this is for y. Why a rational investor prefers x? Because if you draw your indifference curves, so, so one that is tangent to it, that would be this one. You, let's suppose you y, and one that would be tangent to this, that would be above, like the more in this direction. So that would be preferred one. So this asset, if this risky asset is x, then that would avail me the more preferred, like the investment combination which gives me higher utility. That's why an individual prefers to invest in the risky asset of type X in comparison to risky asset of type Y. Okay. So these were the like these were the points of discussions. Like we essentially put our groundwork for our discussion of the portfolio theory. Like for that, like we needed our budget constraint in the form of mean return and standard deviation that we derived, and we wanted to discuss about preferences, like what are the preferences, how do we represent them, and what is the use of them. And once we know them, what is my optimal investment bundle or my optimal consumption bundle in the case of consumption, and in the case of investment, what is my optimal investment bundle. So that's why we discuss choice theory, because portfolio theory is essentially that, like, because you want to choose a particular type of portfolio which gives you the highest amount of utility. Correct. So this was the discussion of week 6, and in week 7 we started our discussion about with like discussing a special type of preferences which we call the mean variance preferences. And what do we mean? Like the mean variance preferences are the ones which only depend on the mean return of the portfolio. This is your expected return. this is your expected return. This is your variance. Sigma square is your variance. And what is this parameter A? We call this as the risk aversion parameter. Why aversion? Because this is with a negative sign of the variance. Variance, as we earlier discussed also, variance is a measure of risk, and this parameter is coming with a negative sign. So this is measuring the individual's aversion against a, against a, against risk. So that's why we call it risk aversion parameter. And what is the role of this risk aversion parameter? How it impacts your indifference curves? If we look at that, so here it would be sigma and mu. So if my risk aversion parameter is less, then it is less steeper. If it is higher, it is more steeper. And yeah, this is the why this risk aversion parameter matters. The individual which has higher risk aversion parameter, he would try to avoid risk more in comparison to the individual which has lower risk aversion parameter. Okay, and there was a small discussion about short selling also. So short selling, what do we mean by short selling? Short selling means like you sell asset which you don't own. Like you don't have an asset, but still you are selling it. How this process works? So what you do essentially is in present period today what you do, you borrow a particular asset. Let's suppose you want to short sell Tata Steel shares. Okay. So what you do, you will borrow the amount of shares. For example, you want to short sell 100 Tata Steel shares. Then you go to the market, you borrow 100 Tata Steel shares at the current price, that is P naught, and you sell these to a individual or another investor who wants to buy them. And later at some point of time, for example, today you bought it and you want to sell that after 3 months. You want to sell it after 3 months. What you do, you go to the market and you purchase 100 Tata Steel shares and you again return it to the lender. And who are these lenders? Generally, these lenders are brokers. Brokers means the individuals who like they facilitate this buying and selling of these financial assets. We call them brokers. Okay, this is the short selling process. And in this case, like when so if you short sell, then when will you make money? You will make money when prices go down. How? So what you did, like you sold this. So for example, we took the Tata Steel example. Okay. Today, if Tata Steel's price is 100 and after 3 months, it becomes 90. So for example, you are selling only one. Then what you do, like you sold it at 90, you bought it at 90 and like you returned it to, so you made a profit of 10 rupees. And if price go up by this, then you would make a loss of 10 rupees. This is like the simplest version of short selling. If you have any doubts regarding short selling also, please let me know regarding that also.
Sir, can you just repeat once more the short selling part?
Sure. So by short selling, what I mean, so for example, let's suppose you want to short sell Tata Steel shares. Okay, 100 of Tata Steel share, 100 shares, okay, 100 shares of Tata Steel you want to short sell. And let's suppose the current price is 100 rupees and after 3 months its price becomes 90. Okay, so what you did today, what you did, you went to your broker. Let's suppose a broker, anyone who is sitting, who do this trading thing. You go to him, you say him like, can you borrow me 100 shares of Tata Steel? He said okay, and you borrowed that and you sold that to some other investor. Let's suppose me, you sold them to me 800 rupees. Okay, so you got 10,000 rupees today. Okay, after 3 months, the price drops to 90. Then what you do? You go to the market, you purchase these Tata Steel shares from the market. Like there would be some other investor you would want to who would want to sell them at 90. So you purchase at 90. So you are this is your plus. You got this, and you are paying this much amount after 3 months. So essentially, you are making 1,000 rupees as profit. But
Okay.
in the second case, if the price has gone up to 110, in that case, you would make a loss, and your loss would be minus 1,000 rupees. And as
Just
we
one
discussed in the
question, sir.
yeah, tell me.
Like short selling, I can go for a long buy.
Long buy means how?
I mean, short selling means during that period means when I am basically sell hundreds Tata share, and
Hmm.
after 1 month I am buying that 100 Tata share to square up my position.
Yes.
During this month period, if Tata
Hmm.
company declared some dividend, am I eligible to get the dividend as
No,
per the share I am
no, no,
trading?
no, no, no. In
Oh,
short
that
selling,
I
you
am not
are,
eligible.
yeah, that you are not, because you are not owning them, correct? You borrowed them and you sold to someone else. If Tata Steel sends some like the dividends, then those will go to that individual whom you sold.
Okay.
Okay,
Who buys?
like as we discussed in our,
But means
I think,
those who are holding the Tata share, Tata company share.
yes, those who holding, they will receive the dividend. That is the meaning of dividend. Like the individual who is currently holding the share, he will receive the dividend.
Okay.
Okay. So in short selling, like in many of the markets, this short selling is prohibited. Why? Because the you can make unlimited amount of loss because you do not know if price keeps on rising, then your amount of loss like in keeps on increasing. So that's why in many of the markets, this short selling concept is banned completely from those markets. Okay. So now, so coming to week 7 discussion where so now we are starting our discussion of portfolio theory. So in portfolio theory, like we just have a quick recap of like the statistics, like the mean is like the sum of 1 to n wi ri, where w is the weight, ri is the return of asset I. So let's suppose you are building a portfolio from n assets. Okay, portfolio of n assets. Okay, and you are giving wi weight to an asset I. Okay, so if this is the case, then your portfolio return would be like the portfolio mean return would be wi ri. Ri is the so ri is the average return of asset I, and similarly, like this sigma is the covariance of asset I and asset J. Okay, this ri is this sigma I is covariance of asset I and J. So portfolio return would be the weighted sum of all the average returns of all the assets and portfolio variance will be the this is this will be, there will be n square such terms, so wi wj and sigma ij. So if I and j both are equal, then this sigma ij becomes the variance of that particular asset. Okay, and the correlation is nothing, just the covariance divided by the standard deviation of those particular assets. And these are some basic statistical notations. And in the class, in the lectures, we had a extensive discussion about diversification. What diversification mean? You include more assets in order to diversify your risk. If you include more assets, then your your then your risk would be less. Risk mean your variation would be less. And we the like sir discussed it extensively in the lectures, how this diversification works. And this diversification works better when there is less correlation between the assets. If correlation is high, then there would be less benefits from the diversification. Okay. So if you have any, so for regarding diversification, I would recommend you to go to this online tool that is developed by this Rice Business School, which is called as Learn Investment at the at, this is developed by Rice Business School, and this is called as Learn Investments. And this gives you an interactive platform, so where you can change your parameters, you can change your average returns, you can change your standard deviations, you can change the covariances, correlations, etc., and you can look at how your portfolio is performing, how different parameters regarding your portfolio is performing, how those are changing with respect to changes in these types of assets. So I would recommend you, and we will go through it in our next live session. We will go through it extensively, and we will do a simple example using Excel or any other spreadsheet I would be doing on Excel, where what I would do, we will take any 3 or 5 assets, and from that we would try to get the this we will try to go through this portfolio theory. We would try to get the feasible set, minimum variance set, and we would try to get the minimum variance portfolio set. So that exercise we will be doing in our next live session. And in portfolio theory, what we do, I will give you a brief about these 4 terms, and we will do a extensive discussion about it in our next live session, because in week 8 also we continue our discussion regarding portfolio theory. Okay, so now as we discussed, we will be doing our analysis in standard deviation and mean coordinates. And now let's suppose you have 2 assets. One asset which has if I call it mu1, I call it sigma1. Another asset is here which is mu2 and which is sigma2. Now let's suppose the sigma1 2, that is the covariance between these 2 assets, is given to this is the covariance. Okay, now if these all things are given to you, then what you can do, if you go to that Rice Business School platform, so there if you give these parameters, you give some value to mu1, some value to mu2, sigma2, sigma1, and sigma1 2. If you give these some values, then you would get a a curve like this. What is this? This is, so what you will get, so first you will get a feasible set. Feasible set means this is the combination of mu and sigma that is available to you, correct? That is the meaning of the feasible set. Okay, so it will give you like what are the points which are available to you. So it will give you some of like all these points which are between like these things. All these points will be available to you. So the points which I am representing by this cross, green crosses, those are your feasible combinations of mu and sigma which are available to you. Okay. Now, if you like the if you try to look at the like the leftmost boundary of this one, so what this that comes out to be like that comes out in this form. Okay, so like this will be combined with this one. So this blue line is the leftmost boundary of your feasible set, and we call this blue line. So this yellow one, this green one is your feasible set. This blue one is your minimum variance set, and now why minimum variance set? So why we call that minimum? So how do we get this feasible set? That is like you have you give some weight to this asset one, some weight to asset two, and you vary these weights. Okay, and from that combination you get some combination of like your portfolio mu and portfolio with standard deviation, and from this you get this feasible set, and you get this, and the leftmost boundary we call that minimum variance set. Because why? Because let's suppose if you take any point, so any at any mu, okay, if you take a straight line, so why we are interested in this minimum variance set? Because so for any given mu prime, let's suppose you would always choose the point which has the least variation, correct? That's why we are only interested in this minimum variance set, that is the leftmost boundary of your feasible set. Now, now if you look at like there is the this farthest left, like this point is the one which is having the minimum variation. So minimum variation is like this is the least variation, least standard deviation which I can get by forming a portfolio with these two assets, asset one and asset two. So we call this purple one, this is my global minimum variance portfolio. This one. Okay. Now, if you take a look, if you take a deeper look, okay. For example, if I take this color yellow, okay. Now, if you take any vertical line, for example, here, if you take any, so if you take any vertical line here, now, if you like, you are what you are doing, you are fixing your variation. Now, if you are a rational person, rational individual, then you would always choose this top portfolio in comparison to this bottom. Why? Because you prefer higher return in comparison to less return. So if I apply this condition, then I would be interested only in these points, like the points which are above this global minimum variance, points which are above this global minimum variance portfolio, and which are the part of minimum variance yet. I a rational individual will only be interested in this part of it. Okay. So we covered this one, we covered global minimum, and we covered feasible set, minimum variance set, and follow. We will continue our discussion of this portfolio theory from our next live session, and we will like what we did, like we decided our preferences, to derive our optimal investment choice and optimal investment choice. This is the main goal of goal of our portfolio. Sorry, like what is the most optimal investment choice which you can make given your preferences and like the risk aversion parameters, etc. Okay. Do you have any other questions? If you have any, please let me know. Hello.
No, sir. Okay. Thank you.
Okay. Okay. So okay.
Sir,
So
will
I
you
have
share this note with us?
yes. I will be sharing this with the POD team, and they will upload it to like the Google Drive for live session.
Thank you, sir.
Okay. And I have one more request. So like I will be taking next week's live session also on Sunday due to some other commitments on Saturday. So I will not be available on Saturday 6 p.m. So I will be taking the live session on Sunday this time, like 6 to 7. Is that fine to
Okay,
you?
sir. Okay.
Yeah, I will
No
be
issue.
like drop a message in our Google discussion group. Okay. Okay then. Thank you everyone. Thank you. Thank you so much for joining. See you next week.